5 out of 7 speakers are right at the same time. When consensus gets this tight, the move accelerates. Right now, the S&P 500 is at 7,230.1, the 99th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection. The volatility expert says the VIX term structure is warning of a volatility event. Snyder says the euro-dollar system is tightening and nobody sees it. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The scoreboard just changed. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. The commodity analyst called it commodity supercycle. Oil at $105 confirms it. 134-day streak. Gammon is right, and the data keeps proving it. Yield curve at 0.51%. 3 days running. Snyder called it dollar liquidity crisis. Yield curve at 0.51% confirms it. 3 days running, the volatility expert called it volatility expansion. VIX at 16.9 confirms it. 3 days running, the dollar analyst just moved from wrong to right. The dollar analyst is right, and the data keeps proving it. Gold at $4,575. Too early to call McElroy right or wrong. The thesis is building but not confirmed. 133-day streak. Hartman might be right, but the data has not confirmed the thesis yet. 127-day streak score. Today, 5 right, 2 early, 0 wrong. When consensus gets this tight, moves accelerate. Stay positioned. Today's big question. Everyone agrees on volatility. So who's wrong? The volatility expert says the VIX term structure is warning of a volatility event. Snyder says the euro-dollar system is tightening and nobody sees it. Everyone agrees. In markets, that is usually the setup for a reversal. The crowd is most confident right before the data breaks against them. Both VIX and the MOVE index are falling together. When multiple signals confirm the same direction, the move tends to accelerate. VIX at 16.9, 60th percentile, down 10.2% today. The MOVE index at 70.4, 30th percentile, down 2.3% today. Bottom line, everyone agrees. The data hasn't broken yet. History says watch for the reversal. If VIX breaks above 35, that confirms the volatility expansion thesis. Right now, it is at 16.9. If the MOVE index drops below 100 while VIX stays elevated, it is equity-specific risk, not systemic. VIX at 16.9 will track it daily on the scoreboard. The MOVE index at 70.4 will track it daily on the scoreboard. Phase 1 is the good times, but good times do not last forever. Here's how close we are to the edge. We are 69 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet. But we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points. Currently at 81 basis points. At this week's pace, that is roughly 69 weeks of runway. That is late August. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has initial jobless claims, yield curve flashing red. Gammon says the Fed is breaking things and credit spreads will blow out. The data agrees with that assessment. Phase 1 holds with 69 basis points of buffer. Conditions favor risk but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. Beaufort County SC payment burden is past the breaking point. Sheldon, SC, median home about $2,327,000 on about $117,000 household income. Price-to-income ratio, 19.9. When the math stops working, sellers find out before buyers do. Curry, OR, payment burden is past the breaking point. Sixes, OR, median home about $415,000 on about $21,000 household income. Price-to-income ratio, 19.8. When the math stops working, sellers find out before buyers do. MI, days on market is spiking in Warren. Days on market in Warren moved plus 100% in 30 days, now 147 days. Buyer leverage score, 50-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, everyone agrees on volatility, so who's wrong? Let me show you what happened the last time we were here. The MOVE index at 70.4, the 30th percentile. Notable but not extreme. In 2023, the MOVE index hit 180 during the SVB crisis, signaling extreme rate uncertainty. In 2022, bond volatility stayed elevated all year as the Fed hiked aggressively. In 2020, the MOVE index spiked above 160 as Treasury markets briefly froze in March. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, VIX at 16.9 is in the 60th percentile. The last time both the MOVE index and VIX were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, the volatility experts should be paying close attention because the clock is ticking on this pattern. Here is what the data says to do right now. Stay alert on VIX. It is dropping 10.2% today. Fast moves demand attention. Avoid Phoenix at 40% payment burden, that is stretched territory. Phase 1 holds, no alarms. But the runway at 69 basis points is shorter than last month. 5 out of 7 speakers are right. The commodity analyst, Gammon, Snyder, the volatility expert, and the dollar analyst. When this many align, the trend usually has legs. Every signal is live at analyze.builderslens.com. The talking heads give you opinions. We give you the numbers. Subscribe and I will see you tomorrow morning with a fresh scoreboard.